This chart tracks the Indian rupee against the US dollar. In early 2026, the ticker crossed a threshold that had never been breached before, hitting 95 to the dollar. That downward line represents an 8.01% annual depreciation. This decline positions the rupee as one of Asia's worst-performing currencies for the year. Standard market logic suggests that a currency falling this fast signals a crisis. It is usually associated with capital flight or a domestic economy in distress. In these scenarios, the expected response is for a central bank to intervene. They typically use their foreign cash reserves to buy their own currency and stop the slide. The Reserve Bank of India's current position contradicts that expectation. They hold a war chest of nearly $700 billion in foreign exchange reserves. They have the ammunition to defend the rupee, yet they are choosing to keep those reserves in the vault. This depreciation is a calculated, managed adjustment to severe external shocks. The pressure on the rupee is driven by trade policies in Washington. This chart compares U.S. tariff rates enacted in August 2025. India faces a 50% tariff, exceeding China's 30% and Vietnam's 20%. This targets $45 billion in exports. By September, Indian exports to the U.S. dropped 20.4%, producing incoming dollars. The second pressure stems from India's structural trade deficit and its dependency on foreign energy. India imports 90% of its crude oil. Every barrel must be purchased with U.S. dollars. When the U.S.-Iran war pushed Brent crude prices past $110 a barrel, India's dollar requirements accelerated to cover the rising import bill. Domestic consumer habits added to the strain, as a 200% surge in gold imports increased the demand for foreign currency. The third factor is the movement of global capital away from emerging markets. This chart tracks foreign portfolio investment through 2025. By the end of the year, a total of $16.5 billion had left the country. Institutional money sought higher interest rates in developed markets and moved to avoid the uncertainty of new trade barriers. The rupee is weakening because of global dollar demand. The economy is paying for expensive oil, covering capital outflows, and navigating trade wars. To manage this environment, the Reserve Bank of India maintains a restrained intervention strategy. They refuse to defend an arbitrary exchange rate or exhaust their reserves to fight global commodity cycles. In March 2026, the RBI implemented the net open position cap. Previously, commercial banks could hold 25% of their net worth in U.S. dollars. Speculating, some banks built dollar positions exceeding $1 billion. The RBI restricted this to $100 million. Banks had until April 10, 2026 to rebalance their balance sheets to meet this new limit. This rule change forced a mandatory sell-off of U.S. dollars across the banking sector, injecting immediate liquidity into the market. Regulatory limits forced the market to inject liquidity. The RBI supported the rupee without spending its own foreign reserves. Evaluating the currency through advanced indicators provides a detailed picture of its health. First, volatility. The coefficient of variation is 1.7%. A low 1.7% variation indicates the depreciation is predictable, avoiding the chaotic swings seen in a currency crisis. Next, the real effective exchange rate, or REER, tracks the rupee against a basket of 40 trading partners. A 7-year low in the REER indicates the currency is undervalued, improving the competitiveness of Indian exports. Finally, look at import cover, which measures how long a nation can fund essential purchases without new external capital. At 11 months, this buffer protects the economy from immediate balance of payment shocks. These metrics confirm that the current depreciation is a structural adjustment that supports domestic industry. The rupee at 95 reflects the cost of $110 oil, steep tariffs, and shifting capital flows. This managed slide functions as a wealth transfer across the Indian economy, creating distinct groups of winners and losers. Importers face higher costs for essential commodities like oil, as well as foreign electronics and education. Conversely, exporters see their profit margins widen as they convert dollar revenues into more rupees. This helps the IT services sector and pharmaceutical companies remain competitive globally. Analysts expect the currency to trade between 92 and 97 per dollar through late 2026. Maintaining this range depends on stabilized oil prices and potential progress in trade negotiations. In the current environment, emerging market currencies prioritize managed flexibility over fixed stability. The RBI is using the currency as a shock absorber. This controlled depreciation preserves India's macroeconomic stability in a volatile global market.